This is the Daily Market Comment by Harlambos Bisuros. I'm Maria Pachurdes. Thanks for joining us at XM.com. The dollar fell against most of the other major currencies on Friday, accelerating its tumble at the start of this week. The initial round of selling was triggered by the US employment report, which, despite pointing to another month of stellar employment gains, also revealed a rising unemployment rate and slowing monthly wage growth. Just after Fed Chair Powell's hawkish remarks before Congress, investors assigned a large probability for a 50 basis point hike at next week's FOMC gathering, but the uptick in the unemployment rate and the slowdown in wages made them have second thoughts about that. The second and more prominent episode of dollar selling was initiated as soon as the market opened for this week, and the catalyst was news that the Fed and the US Treasury will implement a range of measures to stabilize the banking system after the fallout from the collapse of the Silicon Valley Bank, SVB. Following the turbulence and the Fed's response, investors took bets for a double hike off the table, with some of them now believing that the Fed will not press the hike button at all. All three of Wall Street's major indices slid more than 1% on Friday after SVB's collapse, with the tech-heavy Nasdaq losing the most ground. Combined with a concurrent fall in Treasury yields and a surge in the SVB VIX index to levels last seen in December, this points to nothing else than a flight to safety episode, with investors abandoning equities in favor of Treasuries. The panic seems to have eased today following the announcement of contingency plans, with U.S. stock futures rebounding strongly and recovering Friday's losses, but that was before coming under renewed pressure around the European opening. Gold prices surged to a one-month high just a few minutes after the open. The slide in the US dollar and Treasury yields, as well as some safe haven inflows, helped the precious metal jump higher on Friday, but today's early relief did not result in a notable retreat. The next item on the agenda that could shake investors' estimates is tomorrow's US CPI numbers for February. The headline CPI rate is expected to accelerate its slide again. With the year-over-year change in oil prices falling deeper into the negative territory, a notable slide in the headline CPI rate seems more than normal, and thus investors may pay more attention to underlying inflation dynamics. This is today's Daily Market Comment. Thanks for joining us at XM.com.